Hey, welcome back to the channel where we make investing easy, fun, and maybe even a little entertaining. Today, we're diving into one of the most heated debates in personal finance. No, it's not whether pineapple belongs on pizza, though for the record I say yes. It's the epic showdown of ETF versus mutual fund versus index fund. If you've ever stared at your brokerage account like it was a foreign language, wondering which of these to choose, this video is for you. By the end, you'll know the pros, cons, and which one deserves a spot in your portfolio. Oh, and don't forget to stick around for my top tips for beginners at the end. And hey, if you enjoy this video, hit that like button, subscribe, and share it with your friends, because sharing investing knowledge is way better than sharing cold fries. All right, let's break it down. What the heck are ETFs, mutual funds, and index funds? And why do they sound like something out of a sci-fi movie? ETF, Exchange Traded Fund. Think of an ETF as a stock market smoothie. It's a mix of different stocks, bonds, or other investments blended together. So you get a little taste of everything, but unlike a mutual fund, you can trade ETFs all day long, like you're flipping stocks. Want Tesla and Apple in one gulp? Boom! There's probably an ETF for that. Mutual fund. This is the OG of diversified investing. A mutual fund is like a slow cooker. You put in your money, and a professional fund manager does the work for you. They decide what to buy, sell, and hold. You don't have to think about it, except when you see the fees. More on that later. Index fund. The minimalist of the group. An index fund is designed to mimic the performance of a market index, like the S&P 500. It's the financial equivalent of if you can't beat them, join them. They're simple, cheap, and efficient. No fund manager needed. It's all on autopilot. So in summary, ETFs are like the stock market's Swiss Army knife, mutual funds are the old-school convenience option, and index funds are the set-it-and-forget-it champions. Now let's get into the juicy stuff, the pros and cons. No investment is perfect, kind of like no family dinner is without drama. ETFs, pros and cons. Pros, flexibility. You can buy and sell ETFs like stocks. Low fees, most ETFs are cheaper than mutual funds. Diversity, tons of options from tech to tacos. Cons, over-trading temptation. Just because you can trade all day doesn't mean you should. Complexity, some ETFs, like leveraged or inverse ETFs, are not beginner-friendly. If ETFs were a person, they'd be the friend who's fun to hang out with but might encourage you to make questionable late-night decisions. Mutual funds, pros and cons. Pros, professional management, someone else does the work. Great for beginners, set it and forget it mostly. Cons, high fees. Some mutual funds charge fees like they're running a 5-star resort. Trading restrictions, you can't trade them during the day, only at the market close. Imagine trying to sell your mutual fund at 10 a.m, only to hear, sorry, we're not open for business until 4 p.m. Like, what is this, 1992? Index funds, pros and cons. Pros, low fees, some of the cheapest investments you'll find. Simplicity, you know exactly what you're getting. Performance, historically they've beaten most actively managed funds. Cons, no customization. If you want to beat the market, this isn't your tool. Boring. Not much excitement here, just steady growth, which might be perfect for you. All right, it's time for the big question. Which one should you choose? It's like picking a team in gym class, except this time everyone wins if you play your cards right. If you're just starting out, go with an index fund. They're low cost, easy to understand, and a great way to dip your toes into investing. If you want more control, ETFs might be your jam. You can trade them whenever you want, and there's an ETF for almost every investment theme. If you're hands-off, mutual funds are great for people who want a professional doing the work. Just watch out for high fees. Aim for no-load mutual funds if you can. Let's put this in relatable terms. Coffee. Say you have $5,000 to invest and you're deciding between an ETF, a mutual fund, and an index fund. The ETF charges a fee of 0.1%. That's like buying a cup of coffee for $5 and paying a tip of a nickel. The index fund charges 0.2%. You're now tipping 10 cents. The mutual fund charges 1%. Suddenly you're tipping $1 for every $5 coffee. That's not cool. The moral of the story? Watch those fees. They add up faster than a daily latte habit. Here's the secret sauce to picking the right investment for you. Know your goals. Are you saving for retirement? Short-term gains? Your answer matters. Check the fees. Low-cost options are your best friend. Diversify. You don't have to choose just one. Mix and match based on your needs. Don't overthink it. The best investment is the one you stick with. Analysis paralysis is real, my friend. And there you have it. ETFs, mutual funds, and index funds demystified. Each one has its place, but the key is figuring out what works best for you. Remember, the goal isn't to have the fanciest portfolio, it's to build wealth over time in a way that fits your life. If you enjoyed this breakdown, do me a favor, like this video, subscribe to the channel and share it with someone who's still trying to figure out if ETFs are something you eat. Let's help them get on the path to financial freedom too. Thanks for watching, and I'll see you in the next video. Until then, keep investing, keep learning, and keep crushing those financial goals.